to IPC, Infinite Possibilities in Complexity. In this episode, we are going to focus on shifting landscape for the bank as part of delegated payments. Joseph, up to now, we've talked about trust models and protocols. Let's make this practical. If agentic payments are real, what's impact to the bank? What must banks do?
This is the critical shift, Natalie. Banks don't need to become AI companies. They need to become delegation infrastructure providers. There are 3 core capabilities banks must build, and none of them are optional.
Let's start with identity. Agent identity. Who is acting? What does agent identity mean in a banking context?
Today, banks know people, accounts, devices. In agentic commerce, banks must also know which autonomous agent is acting and on whose behalf. An agent is not a user. It's not an API key either. It's a delegated digital actor. So banks must issue agent IDs bound to a human or a corporate entity or a business function with clear metadata, purpose, scope, expiry, revocation rules. Think of it as, this AI agent represents procurement, operations, not Joseph, not the vendor.
So this is like a digital employee?
Exactly, but one that can act 24/7 and at machine speed.
Once an agent has an identity, how does the bank control spending?
Through mandates. This is the heart of AP2. Mandates are cryptographically signed delegations of authority. For example, spend up to 100,000 Singapore dollars, only with approved vendors, only for specific categories, only until a certain date. For corporates, this maps cleanly to digital board resolutions, delegation of authority matrices, procurement policies. The bank's role is to issue, store, validate, revoke these mandates.
So instead of approving every transaction, banks approve the rules.
Exactly. This is a mindset shift from transaction authorization to policy authorization. Once the mandate exists, agents can operate continuously without human friction, but never outside the rules.
What about actual payment credentials? Cards, accounts, stablecoins?
Agents should never hold raw credentials. Banks must provide credential vaults that store cards, accounts, wallets, tokenize them, release them just in time to agents. This is where banks retain real power. The agent says, "I have a valid mandate. I need to pay." The bank responds, "Here is a tokenized credential, valid for this transaction only." That credential could be a card token, a real-time payment rail, or even a stablecoin wallet address, but always scoped, auditable, revocable.
So banks stay in control, even knowing why a payment happened.
Exactly. Banks don't lose visibility, they gain context. They see which agent acted, under which mandate, triggered by which event. That's far richer than today's merchant plus amount logs.
Can you summarize what the bank's new role looks like?
Sure, pulling it together. The bank's new stack in a very simple way. Banks must build 1. Agent identity services to know who is acting. 2. Mandate and delegation engines to know what is allowed. 3. Credential vaults to control how value moves. If banks do this well, they become the trust anchor of agentic commerce. If they don't, agents will root around them.
So this isn't about protecting legacy, it's about enabling the next layer of commerce.
Spot on. Agentic payments will happen. The only question is, will banks power them or be bypassed by them?
Welcome back to